Most retirees have no idea that this unbelievable tax strategy even exists. Hi, welcome to another video episode of Wealth, Healthcare and Retirement Strategies, and boy, do I have something exciting for you. Before we dive in, if advertisements should interrupt this video, please do not click off of the advertisements. Please allow them to play through as a thank you to me for bringing you this honest, valuable information for free. Now let's continue. Today we focus on a particularly compelling technique, tax gain harvesting, an often overlooked cousin of the more common strategies, which holds the key to this remarkable tax-free income stream. This is a high-level financial maneuver we use to secure long-term prosperity and ensure generational wealth transfer is tax efficient. The core objective of today's session is to thoroughly demystify tax gain harvesting, to illuminate its underlying mechanics, and to provide you with a step-by-step roadmap detailing precisely how you can leverage this powerful approach to unlock that $126,700 of completely tax-free income in 2026. To begin our deep dive, we must first establish a firm foundation by defining exactly what this strategy entails and why it represents such a significant financial advantage over conventional withdrawal methods. Ultimately, the goal is to optimize your lifetime tax exposure, ensuring that your hard-earned assets work for you, not for the government, thereby maximizing your net worth. It's all about creating a transformative financial impact through careful planning and professional execution. So, what do we mean by the strategic selling of appreciated assets? At its very essence, tax gain harvesting is the strategic and intentional realization of capital gains by selling appreciated assets within a taxable brokerage account. This action is specifically timed to coincide with a period when your overall ordinary income places you in a low to zero federal tax bracket. This is a highly deliberate action. You are choosing to sell investments that have significantly increased in market value at a predetermined tax rate, which in our ideal scenario is the 0% long-term capital gains rate, the most favorable rate in the entire tax code. This concept is fundamentally and strategically the antithesis of tax loss harvesting, a strategy you may be more familiar with, where one sells a losing investment to offset realized gains or a limited amount of ordinary income. While tax loss harvesting is valuable for mitigating current year taxes, it often involves generating less income. Instead, tax gain harvesting allows us to intentionally generate a substantial amount of capital gains income while keeping the tax rate at zero, a far more proactive step in wealth management. Therefore, tax gain harvesting represents a more proactive, long-term wealth optimization strategy, arguably offering a far greater magnitude of lifetime benefit, particularly as you approach or enter your retirement years and your income levels fluctuate. This is truly a high-level financial maneuver designed for lasting prosperity. Understanding the context of this strategy is paramount. It's about capturing an ephemeral tax opportunity that exists only when your ordinary income is temporarily low, a common scenario for those in the gap years of early retirement, before required minimum distributions, RMDs, kick in from tax-deferred accounts and before Social Security benefits begin. This targeted approach allows you to cleanly extract wealth from your non-retirement investment vehicles at the lowest possible tax cost, effectively future-proofing your financial position against potentially higher ordinary income tax rates down the line, which may occur due to RMDs. By taking this action now, we are repositioning appreciated holdings to mitigate future embedded tax liabilities, a sophisticated move that maximizes your net worth. This process of intentionally realizing capital gains at a 0% rate is the very definition of a tax-efficient wealth transfer. To proceed with this strategy, we must understand the essential role of the taxable brokerage account. Now let's talk about the absolute prerequisites for executing this strategy successfully. The entire operation hinges on the existence of and your active engagement with a taxable brokerage account. It is critical to grasp that this sophisticated strategy cannot be implemented within an IRA, a Roth IRA, or a 401k retirement plan. These qualified retirement accounts are tax-sheltered. They generate no annual capital gains or losses subject to tax, and your tax liability is deferred or eliminated entirely until funds are eventually distributed. Furthermore, withdrawals from tax-deferred accounts like traditional IRAs or 401ks are always taxed as ordinary income, meaning they never qualify for the preferential, lower long-term capital gains tax rates that are central to our strategy. This distinction is vital because the taxable brokerage account is the only tool that allows us to manage and control the type of income realized for tax purposes. The strategic advantage of the taxable brokerage account lies precisely in its tax treatment of realized gains, which is separate from ordinary income. Yes, with a brokerage account, you must report dividends, interest, and realized capital gains annually, which is the trade-off for its flexibility and capital gains structure. However, this very structure allows you to strategically align the realization of gains with specific low-income years, permitting you to realize those long-term capital gains at that highly coveted 0% federal tax rate. This ability to isolate and control the tax rate on a portion of your wealth is the cornerstone of the tax gain harvesting strategy, turning what is generally considered a taxable asset into a temporary source of tax-advantaged cash flow. Next, we need to focus on understanding the 0% capital gains brackets. To truly grasp the mechanics of the 0% rate, we must examine the long-term capital gain tax brackets as published by the IRS. For the year 2026, as you can see, the 0% long-term capital gain rate extends quite generously. Specifically, for a couple married filing jointly, MFJ, this privileged 0% bracket for long-term capital gains has a taxable income ceiling of $96,700. For single filers, the ceiling is precisely half of that, at $48,350. This figure is crucial. It represents the maximum amount of long-term capital gains you can realize and pay absolutely zero federal tax on, assuming your other ordinary income has not already filled that bracket space. The strategic brilliance here is that this 0% bracket is determined by your taxable income, not your adjusted gross income AGI. This distinction is monumentally important, as it means we must first account for the standard deduction before calculating the income that hits the 0% bracket. The standard deduction acts as a zero tax buffer, reducing your AGI to your taxable income. By carefully coordinating the realization of long-term capital gains and factoring in the standard deduction, we unlock the full potential for tax-free income generation. Let's now move into an illuminating example calculation to solidify this concept and demonstrate precisely how we arrive at that impressive $126,700 figure for a married couple. For the sake of a clear, instructional demonstration of calculating the total tax-free threshold, we will assume a hypothetical retired couple married filing jointly. Crucially, we assume they are currently in a low-income phase, meaning they have no earned income, are not yet taking RMDs from their IRAs, have deferred Social Security, and have no significant rental or pension income, resulting in a $0 baseline ordinary income. This simplified starting point allows us to clearly illustrate the maximum power of this tax optimization without the distractions of other income sources. Our analysis relies on the standard deduction for married filing jointly, which is projected to be approximately $30,000 in 2026. Now, let's combine the two key components, the standard deduction amount and the 0% long-term capital gains bracket ceiling. The 0% bracket extends up to a taxable income of $96,700, and we add the $30,000 standard deduction back into this figure to find the AGI threshold. When we sum these two amounts, $96,700 of capital gains plus the $30,000 standard deduction, the result is a total adjusted gross income, AGI, threshold of $126,700 that they can generate while paying exactly 0% federal tax on the capital gains component. This maximum AGI represents a significant financial milestone for tax-efficient retirement income. Now that we have our target, we must look at deconstructing the hypothetical portfolio to see how to achieve it. To make this actionable, let's look at our couple's hypothetical portfolio composition. They have a total retirement asset base of just under $1.5 million, strategically distributed across three distinct buckets. Traditional IRAs, approximately $1 million. Roth IRAs, approximately $100,000. And the all-important taxable brokerage account, approximately $350,000. It is the taxable brokerage account, the vessel for our tax gain harvesting strategy, that demands our full and immediate focus. Within that $350,000 brokerage account, we must establish the cost basis and the embedded gain. We will assume an original cost basis, the amount of their own capital invested, of $175,000. This means the account has experienced 100% growth since inception, resulting in $175,000 of unrealized long-term capital gains. This precise 50-50 ratio of basis to gain is a simplifying yet powerful assumption for our calculation, making half of every dollar sold a realized capital gain. This ratio allows for a clean calculation of the necessary gross sale amount. We must also adhere to ensuring long-term capital gain status. A non-negotiable condition for this strategy is that the assets sold must qualify for long-term capital gain, LTCG treatment, as defined by the Internal Revenue Service. As defined by the IRS, an investment qualifies for LTCG rates if it has been held for longer than 1 year and 1 day, more than 365 days. Selling an asset before this crucial holding period is met results in a short-term capital gain, STCG, which is taxed as ordinary income at potentially much higher rates, completely nullifying the intended benefit of the tax gain harvesting strategy. For our example, we assume our couple has held these appreciated investments for well over 10 years, comfortably satisfying the LTCG requirement. With our target AGI of $126,700 established, the maximum tax-free long-term capital gain income we can generate, we can now calculate the necessary gross sale amount from the brokerage account. Since the account holds a 50% embedded gain, meaning half principal, half gain, we need to double our target realized capital gain amount to determine the total cash needed to be generated from the sale. This leads us to determining the optimal sale amount, which will be the final calculation for the 0% tax bracket. To realize $126,700 in capital gains, which is our tax-free target, the couple must sell twice that amount from their 50-50 basis to gain portfolio. The required optimal gross sale amount is thus $253,400, $126,700 times 2. This means they will sell $253,400 worth of appreciated investments, of which $126,700 is their original cost basis, non-taxable return of principal, and $126,700 is the long-term capital gain, the realized income component. When we analyze the tax calculation on this sale, the beauty of the tax gain harvesting strategy becomes fully evident. The $126,700 in realized capital gains is combined with their assumed zero ordinary income to create an AGI of $126,700. This AGI is then reduced by the $30,000 standard deduction, leaving a taxable income of $96,700. As we established, this figure sits precisely at the top of the 2026 0% long-term capital gain bracket for married filing jointly. The inevitable conclusion is that they have generated a $253,400 cash inflow, a significant financial injection, and will owe absolutely zero federal tax on the $126,700 realized capital gain. The strategic implications of this are vast and extend well beyond the current tax year, driving our discussion on repositioning and future-proofing wealth. Our couple has essentially created $253,400 of non-taxable cash flow. Even if they only need the target $126,700 for their annual living expenses, they are left with an additional $126,700 of surplus cash. This surplus cash allows for unprecedented financial flexibility and control over their retirement funding. With that surplus, they have two highly advantageous options. First, they can immediately reinvest the entire $253,400 back into the brokerage account. This is the cornerstone of the harvesting aspect. By selling and repurchasing, while adhering to the wash sale rule, which does not apply to gains, they have reset the cost basis of the sold assets to the new, higher fair market value of $253,400. This strategic move significantly reduces the unrealized gains, and thus the future tax liability, on that portion of their portfolio. This brings us to the power of cost basis reset. The strategic genius of resetting the cost basis cannot be overstated. By raising the cost basis from $126,700 on the sold portion to $253,400, they have permanently reduced the future capital gains exposure on those assets. Essentially, They have utilized the 0% tax bracket to legally purge a $126,700 embedded tax liability from their portfolio, ensuring that future growth will only be taxed from this new, higher starting point, not the original lower basis. The second, equally powerful option for the surplus cash is to hold the excess $126,700 in a safe, liquid cash equivalent, such as a high-yield savings account or money market fund. This immediately provides them with next year's tax-free income, already in hand, and ready for deployment without further selling. This 2-year income generation in a single year, with a 0% federal tax bill, is a testament to the power of advanced tax planning over simple investment management. Now, let's explore integrating the Roth conversion strategy into this plan. Furthermore, the zero taxable income result opens up additional high-value tax strategies. Since their taxable income is zero after the standard deduction is applied, their current effective tax rate is 0%. This creates an unparalleled window of opportunity to execute a Roth conversion. They could convert a portion of their traditional IRA, up to the $96,700 taxable income limit, and have that conversion income taxed at the lowest possible ordinary income tax rates, potentially even 0% for the conversion amount that fits within the lower income tax brackets. This double whammy strategy, tax gain harvesting and Roth conversion, is the hallmark of peak tax efficiency. To demonstrate the flexibility and robustness of this approach, let's now introduce ordinary income variables into our scenario, making the financial planning more realistic. What happens if our couple decides to take a $20,000 distribution from their traditional IRA, a source of ordinary income, in the same year? This new variable immediately impacts the amount of tax gain harvesting they can execute at the 0% rate, because ordinary income is always taxed first, consuming the lowest brackets before capital gains. The $20,000 IRA distribution is ordinary income, and it consumes the first $20,000 of the room available beneath the standard deduction and the 0% bracket. Remember, their total AGI ceiling for tax-free capital gains remains $126,700. By subtracting the $20,000 of IRA ordinary income from this AGI ceiling, their remaining room for tax-free realized capital gains is reduced to $106,700, $126,700 minus $20,000. With $106,700 of remaining capacity for 0% long-term capital gains, we must now move to calculating the revised optimal sale from the brokerage account. Again, assuming the 50% gain ratio, they can sell twice that remaining capacity. $213,400, $106,700 times 2. This revised sale generates a total cash inflow of $213,400, composed of $106,700 in LTCG and $106,700 in non-taxable cost basis. Their total adjusted gross income is now $126,700, $20,000 ordinary income plus $106,700 capital gains. After applying the $30,000 standard deduction, their taxable income is $96,700, which is precisely the top of the 2026 0% capital gains bracket. Despite introducing ordinary income, the tax gain harvesting strategy remains incredibly powerful, allowing them to extract a substantial $213,400 while still paying zero federal tax on their capital gains component. This dynamic adjustment illustrates the sophistication and adaptability required for high-level retirement planning, a key element of the multi-year optimization perspective. The amount harvested is a direct function of all other income sources and is tuned to the maximum allowed by the tax code. This is not a set-it-and-forget-it strategy. It requires annual reevaluation and calibration to optimize for the shifting tax landscape and your personal financial needs. It's an active process of maximizing your financial efficiency year after year. In conclusion and next steps, tax gain harvesting is a highly effective, proven financial instrument that, when correctly applied to a taxable brokerage account, allows you to systematically and legally extract significant wealth with zero federal tax liability by leveraging the 0% long-term capital gains bracket. This strategy is a critical component of a robust, modern retirement plan, providing tax-efficient cash flow and the opportunity to reset the cost basis of appreciated assets, massively reducing future tax burdens. It is a clear example of how strategic financial engineering can lead to a dramatically improved net retirement outcome. We encourage you to seek professional guidance to evaluate your unique situation and construct your own bespoke tax gain harvesting plan. Subscribe so as not to miss our next value-packed video. Click the thumbs up button to give us a like for bringing you this vital free information. Comment below sharing a helpful tip on retirement wealth and healthcare that will benefit others. Disclaimer: the information in this video is solely for equipping, educating, and empowering.